There's a rule in investing that Wall Street doesn't want you to know about. It's called the 5-3-1 rule, and it's so stupidly simple that most people ignore it. But the people who follow it, they're retiring early, building generational wealth, and sleeping like babies while everyone else is panic checking their portfolios. I'm breaking down this rule in the next 5 minutes. Let's get into it. The 5-3-1 rule is simple. 5. Invest for at least 5 years minimum. 3. Use only 3 core investments. 1. Check your portfolio 1 time per year. That's it. Let me break down each number. Rule number 1. The 5-year minimum. Never invest money you'll need in the next 5 years. Why? Because the stock market is volatile short-term but reliable long-term. Over any 1-year period, the S&P 500 has lost money 26% of the time. That's a coin flip. Over any 5-year period, only 12% of the time. Over any 10-year period, only 4% of the time. Over any 20-year period, it has never lost money, 0 times. So the 5-year rule protects you from bad timing. Here's how to apply this. Money you need in 5 years, savings account. Money you won't need for 5+ years, stock market. Emergency fund, savings account. Down payment in 3 years, savings account. Retirement in 30 years, stock market. Fully invested. This one rule eliminates 80% of investment mistakes. Rule number 2, the 3-fund portfolio. You only need 3 investments. That's it. Fund 1, Total U.S. Stock Market Index Fund. This covers every publicly traded company in America, about 70% of your portfolio. Fund 2, Total International Stock Market Index Fund. This covers every major company outside the U.S., about 20% of your portfolio. Fund 3, Total Bond Market Index Fund. This is your stability. When stocks go crazy, bonds stay calm, about 10% of your portfolio. 3 funds. You're now more diversified than 95% of investors. Why only 3? Because I've seen people with 20 different funds, 15 individual stocks, some crypto, a little gold, maybe some NFTs. You know what happens? They can't keep track. They panic. They sell at the worst time. They lose money. With 3 funds, you know exactly what you own. You understand your strategy. You stay calm during crashes. Here's how to adjust based on age. 20s or 30s, 80% US stocks, 15% international, 5% bonds. 40s or 50s, 60% US stocks, 20% international, 20% bonds. 60s or older, 40% US stocks, 20% international, 40% bonds. Simple, clean, effective. Rule number 3, the annual check-in. Check your portfolio once per year. Not once per month, not once per week, definitely not once per day. Once per year. Why? Because investors who check daily underperform investors who check annually by 2 to 3% per year. That's massive over time. When you check daily, you see red days. You panic, you sell, then the market goes up, you buy back in at a higher price, then it drops again, you sell again. You become your own worst enemy. But when you check once per year, you see the big picture. You're up 12% for the year. Life is good. Here's your annual process. Step 1, pick 1 day per year. January 1st, your birthday. Doesn't matter. Step 2, log in on that 1 day. Step 3, check if your allocation is still correct. If you're now 90% stocks instead of 70%, rebalance back. Step 4, increase your contribution by 1% if possible. Step 5, log out. Don't look again for 365 days. That's it. 15 minutes once per year. What about market crashes? Don't look. Seriously, your job is to keep contributing. The market's job is to recover. It always does. Every single crash in history has been followed by new all-time highs. The 5-3-1 rule works because it removes 3 obstacles. Obstacle 1, impatience. The 5-year rule forces long-term thinking. Obstacle 2, complexity. The 3-fund portfolio eliminates decision paralysis. Obstacle 3, emotion. The annual check-in prevents panic selling. This rule isn't sexy. It's not exciting. But you know what you will have? Money. A lot of it. Because while everyone else is panic selling, chasing hot stocks, and checking their portfolio constantly, you're sitting back, staying the course, and letting compound interest work. Boring is profitable. The 5-3-1 rule: 5 years minimum, 3 core funds, 1 annual check. Follow this and you'll outperform most professional investors. If this changed how you think about investing, smash that like button. Subscribe to Saving Simplified for more strategies that actually build wealth. Drop a comment. Are you following the 5-3-1 rule? Your future millionaire self is counting on you. I'll see you in the next one.